And speaking of NVIDIA, you decreased your position recently, right? So, do you think NVIDIA is overestimated in nowadays market?
No, but I think what our reductions indicates, it's when we look at other opportunities in the market, it's been a good area for us to just reduce the weighting and invest elsewhere.
Can you comment on Tesla as well? Because I think Tesla is struggling nowadays for EV sales.
Yes, I mean we've obviously been a holder of Tesla since 2013. However, recently, as you mentioned, we have reduced significantly our weighting in a number of portfolios and indeed sold out.
You actually invested heavily in China, right? So you are still optimistic about Chinese future, right?
I think there's some extraordinary businesses in China, and I think you're seeing quite a step change in terms of when you think about the richness of the platform that Tencent has managed to develop. I think you're looking at a lot of Western companies looking at Tencent now, and they're learning from Tencent rather than it being Chinese companies looking at the west coast of America and learning from there. I think actually they're comparable, if not exceeding.
And Morningstar recently downgraded your rating from high to above average. The first layer, your fund is in severe environment now.
Yeah, so if you look across the different strategies that we offer clients, some have been performing very well, but others have not delivered the sort of returns that we would expect to deliver to clients. So we clearly need to improve that.
So Rakuten and I think SBI, and you also invested in GMO, right? GMO Internet.
Yes.
Cyber Agent.
Yes.
They also have large ownership in founders.
Yeah.
And it seems that you liked founder ownership. But what is behind that?
Alignment.
You are also famous for investment in Tesla or Amazon. So can you also briefly explain this? So why this Edinburgh-based firm could manage to find these top growing stocks?
Yeah, I think it partly comes from a mindset. What we're trying to do for our clients is we're trying to find the highest growth companies anywhere on the planet. And what we're explicitly looking for is companies that have the vision and the management capability to really disrupt industries. And that comes with some risk, but I think it's our willingness to spend a lot of time to really get to know management, what is their vision, and also what is their ability to execute on that vision. And then if we can find those characteristics, then we're prepared to invest in those companies and support them through the inevitable difficult periods. When you're trying to do something as difficult as what Tesla tried to achieve or what Amazon tried to achieve, it's not going to be smooth. So I think being that very long-term supportive shareholder has actually been very helpful, I hope, to the companies themselves, but certainly for our clients, because obviously that leads to fantastic returns.
You also invested in NVIDIA 2016?
That's right,
So, what was the main motivation for that?
Gavin.
Yeah. Well, what it wasn't was a foresight as to where AI would lead us. So this wasn't, to be clear, a sort of 5 to 10 year head start in the industry as to where we thought AI would end up in the demand for NVIDIA's products. But what it was an awareness that was an option value in the investment. The original investment was really more predicated on the demand for gaming chips. And again, I think there we were speaking to alternative sources, speaking to a different generation, certainly from ourselves, in terms of how much time the youth were spending in gaming and how gaming was exploding as an industry. It was really a play on the power of NVIDIA's chips and the dependency on NVIDIA's chips in the gaming industry. However, we did know that they were a key player in the field of AI.
And speaking of NVIDIA, you decreased your position recently, right? So, do you think NVIDIA is overestimated in nowadays market?
No, but I think what our reductions indicates is a sense of, one of the questions we always ask ourselves when we invest in companies is, what is it that the market doesn't understand? What is it missing? And often what the market is, in our view, missing is the duration of the growth these companies can have, and also the ability to actually increase top line growth, accelerate top line growth from high levels. And often what leads us to sell a company or reduce a holding is an assessment that the market's view is coming round to our view. We're hugely long-term, we're very, very supportive long-term shareholders of companies. However, that's not at all costs. So really recently the view has been more that the market's more coming around to the view of where we think NVIDIA can get to, but we still think it's a fantastic company. So it's when we look at other opportunities in the market, it's been a good area for us to just reduce the weighting and invest elsewhere. But we still see it as a core business that we're owning across a number of portfolios.
Can you comment on Tesla as well? Because I think Tesla is struggling nowadays for EV sales.
Yes, I mean we've obviously been a holder of Tesla since 2013. However, recently, as you mentioned, we have reduced significantly our weighting in a number of portfolios, and indeed sold out of the holding completely in a number of strategies. And it's again not a really long-term view as to what the real value might be in Tesla in years to come, which is probably centered around the autonomous driving. One thing that they have above all other competitors at the moment is a huge source of data. Because being first mover really in this space, it means that they have accumulated a huge amount of data and that we think might well be used by the OEMs over years, and it might be that they become more of a service provider to them in terms of data and technology. However, again, when we looked at how well the company had done from a share price perspective, opportunities we were seeing elsewhere in the markets to invest into, and also the fact that Elon Musk clearly has had quite a lot on his plate recently, we felt that him stepping away in terms of direct engagement in the company just meant when you added those pieces together, it was less compelling than it has been over the last decade. But I'd say that in some of these decisions, reducing NVIDIA, reducing stroke selling Tesla, it's more a reflection on the sheer number of fantastic opportunities we're seeing broadly in terms of growth opportunities elsewhere.
And my question is, can you manage to find next Tesla or next NVIDIA or next Amazon?
I think it's about maximising the probability of finding the next. So the way I would answer that is more, you need to structure your research in a way that gives you the best possible opportunity to find that company. And that goes back to many of Tim's points around different sources of information, willing to be brave and different in terms of the businesses you invest into, accepting these sorts of companies carry risk, because there is a great deal of uncertainty, but you have to embrace that uncertainty. To find these great growth businesses and back them, you have to be willing to be different. You have to be willing to accept volatility, and you have to have fantastic clients, which we're very lucky to have, that support you in that and understand that's what you're trying to do. So are we well placed to find those companies? Yes. Will we find them? Only time will tell. But I feel that we're very well positioned structurally to identify them. And I think that is a competitive advantage that this partnership structure allows us and our client base allows us.
So the web page of Morningstar and Morningstar recently downgraded your rating from high to above average. And yeah, what is your perspective on this? So they said so your fund experienced decreasing of AUM and the first layoff. So yeah, it says your fund is in severe environment now. But yeah, what is your perspective on that?
Yeah, so if you look across the different strategies that we offer clients, some have been performing very well, but others have not delivered the sort of returns that we would expect to deliver to clients. So we clearly need to improve that. That is our focus above everything. So I think that's entirely fair. We know that we need to deliver returns to our clients. So we've been taking steps to improve that, making a lot of investments in the firm, doing some restructuring certainly on our investment floor to help. And yeah, that's entirely fair on the part of Morningstar. We know we need to win back their confidence and win back the confidence of our clients. So we're making some significant investments in that. It doesn't worry me from the point of view of, I think we know, given the way that we invest with a very long-term mindset, that we're going to go through periods of volatility. We're experiencing one of those now, but we've experienced many of those in the past. So it's about retaining your discipline, remembering what we offer clients in terms of we typically fill quite a small portion of their overall portfolio, the very high growth portion of their portfolio. And crucially, it's about retaining your risk appetite. I think there's a very human reaction to when you go through a period of weaker performance to retrench and not back your conviction. And that's something we must absolutely retain, is that ability to back our conviction in companies.
And especially for impact of Trump's tariff. So yeah, what do you think about this tariff for US economy and China economy?
Okay, so this all comes with a huge caveat, right? We would never profess to being macroeconomists. So that caveat's important. One thing I would say is, look, I've read a lot about the end of US exceptionalism, and that this could be, yes, it may well be inflationary for the US. I think you'd be wrong to bet against US exceptionalism. It still remains an incredibly dynamic, vibrant economy which has a lot of the things you would look for to allow you to build great businesses. And by that I mean, quite light touch regulation, fantastic education system, great risk appetite. So yeah, look, it might be slightly inflationary, it might be a bit of a knock near term, but would I bet against the US producing some of the great businesses of the future? No, I wouldn't. I think if you extend, so if that's the view on the US for what it's worth, when you extend it elsewhere, it obviously it's quite an interesting way to approach geopolitics. It's quite confrontational. It's it's a very different approach.
Yeah, you were choosing wars.
Yes, carefully. Yeah, I think people can get slightly overexcited about what it means for other countries. I mean, China is fantastic at playing the long game. So I think if some of the more sort of sensationalist things that I've read about, the impact it's going to have on China are probably over dramatizing the impact it's going to have on China. What we have seen is that it's reinforced China's view that they need to be self-sufficient in as many industries as possible. So you've seen that in terms of what they've done in things like the semiconductor industry. As you know, they spend more importing semiconductors historically than they have importing oil. So here we're talking about $350-400 billion of imports. And they've obviously made great strides in terms of being more self-sufficient when it comes to these sorts of things, and obviously the successes that they've had with things like DeepSeek, point to the improvements they've made there. But also, quite frankly, retail sales in China is 10 times the size of exports to the US. So in terms of the impact that's likely to have on the Chinese economy, it's far more important the health of the Chinese domestic consumer than it is whether the tariffs on China are 10, 20, 30, 40, 50%. So I think there's a lot of noise around tariffs, but the impact that's likely to have is probably over dramatized.
Okay.
Yeah.
So yeah, you actually invested heavily in China, right? Like Tencent.
Yeah, Tencent, Meituan.
Yeah.
With significant investments in China.
And yeah, people say China has geopolitical risks, and I think people are hesitated to invest there recently. But yeah, what do you think about that?
It's quite hard to point to a country at the moment on the planet that doesn't have a geopolitical risk, right? So yeah, look, we all know that there's, when Xi Jinping says that I want to reunify China and Taiwan, you have to take that seriously. What's probably important is over what time frame does that happen, and how does it happen? So look, that is absolutely something that you have to have in the back of your mind when you're investing in China. What does that mean in terms of the risk premium that you'd attach to the investments you want to make in China? It's something you have to take seriously. But I don't think that prohibits you from being quite optimistic about some of the companies that you find in China at the moment, but it probably just has an impact on the price you're prepared to pay for those.
Okay, so you are still optimistic about Chinese future, right?
I think there's some extraordinary businesses
Oh, yeah.
in China, yeah. And I think you're seeing quite a step change in terms of when you think about the richness of the platform that Tencent has managed to develop. I think you're looking at a lot of Western companies looking at Tencent now, and they're learning from Tencent rather than it being Chinese companies looking at the west coast of America and learning from there. I think actually they're comparable, if not exceeding, the richness of the platform there.
Okay, so you do not expect invasion of Taiwan from China. So is it a real risk for Chinese investment?
Well, look, again, I would go back and just say, I think when Xi Jinping says that they want to reunify, you have to take that seriously. But your guess is as good as my guess in terms of how that happens. Does that happen peacefully? Does that not happen peacefully? And over what time frame does that happen? There are lots of guesses as to whether 2027 is that, or whether they just want to do it by the 2047. So we don't know. But I think you have to always have that in the back of your mind, that is a likelihood. But I think you can have a very different view to other market commentators as to how that might happen.
China will be a winner in this trade war, or at least they won't lose at this war.
Yeah, I was going to say, I'm not sure there's ever a winner in the trade war, right? But in terms of, do I think the Chinese economy can do just fine if tariffs are at an elevated level? Yeah, I do. Bear in mind the size of exports to the overall economy. It's not as large as people think. Plus, we think who China is trading with now. The other emerging markets are every bit as important.
So yeah, what do you think about the investment to Japan?
So so when we look at our investments in Japan, we have about $14-15 billion invested in Japanese companies across the whole business, and about a third of that is in specialist Japanese portfolios, so dedicated Japanese portfolios. I think it's fair to say that over the last few years, we haven't seen a significant change in the amount of money we've invested into Japan in our global portfolios. But I think that's got to be viewed in the context of, we run concentrated global portfolios, so the competition for capital is very high. So it's not necessarily a reflection on a negative reflection on corporate Japan. It's simply that we're finding maybe a better investment in a different location. We don't care in those portfolios where businesses are listed. But one thing we are increasingly enthusiastic about in Japan is just that the number of innovative businesses we are seeing that we've held for some time. We don't think the market has fully appreciated those in terms of the level of innovation, but the value that they assign to these businesses. So a lot of the businesses I'm thinking about here are companies like a Rakuten and SBI, where a cyber agent, where if they were listed in the US, they would trade at a very different multiple. And I think there's still the sense that quite a lot of businesses in Japan are somewhat inefficiently managed, and therefore they should trade at a discount to their peers elsewhere. Now, that may be true of some companies, as it is of companies elsewhere, but many of the businesses we're looking to invest into don't really have that headwind. So within our specialist Japanese business, we are really excited about what returns we could see from here, from the companies we're investing into. Whereas in the global portfolios, it's simply more about a question of competition for capital. So we look at a Japanese company the same way we will look at a US company or a European business or Chinese business. And we will look at it on a case by case, and if it's a business that is offering something similar to a competitor elsewhere, but we think the competitor is simply in a better position, then we will likely invest there. So I think that there are an abundance of opportunities in Japan. I think it is improving in terms of that. I think management and the governance of these businesses to allow that to flourish. That will take time. It's probably taking a little bit more time than we thought. But we think innovation is alive and kicking in Japan.
So Rakuten and I think SBI, and you also invested in GMO, right? GMO Internet.
Yes.
And cyber agent.
Yes.
They also have large ownership in founders, I think. And it seems that you liked founder ownership, but what is behind that?
Alignment. I think that it's skin in the game. It's knowing that when you're dealing with a company where there's large founder involvement and ownership still, they're taking decisions that are impacting them as much as their other shareholders, more than their other shareholders in terms of their direct impact. So that alignment that you have is critical. And we know that the reason they've got to a position that they've developed and grown a business to be the size it is gives them the mindset to then keep trying to grow the business over the next 20 years. They're not there to move to care and maintenance. We've seen too often with professional management, you bring professional management in and it becomes more about smoothing the profits over the next few years and really giving the markets what they want to see, and they're not willing to take the brave steps to move the business on to move it to be 2, 3, 4 times the size it is today. Founders have that mentality. So, across the world, when we're looking at businesses, you'll find that a lot of the portfolios we have investments in many companies where there's a high degree of founder involvement and ownership for precisely that reason.